Welcome back. You're watching Stock Picks. Today we unpack Italtile, Transpaco, as well as a Copper 360 with a Small Talk Daily's Anthony Clark. Anthony, an absolute pleasure as always. Good afternoon.
Yeah, good afternoon from a Cape Town that no longer smells of beef.
Well, I'm glad that's the latest development there. Anthony, I'm keen to get how you're doing and how it's been. We haven't spoken in a while.
Yeah, the year started extremely well. From a small cap perspective, we've just hit reporting season. And interestingly, just updating my data points as of this morning, the overall mid-cap market and the Aussie are down probably 3 to 4% year to date. And the small cap market is just clinging on about 1% higher year to date. So once again, it pays to be in the small caps. But I can tell you, as many commentators may have mentioned in this program, liquidity and trade volume on the JSE so far this year has been very, very poor. And with the budget coming up tomorrow and the election, I think it's going to be a very uncertain few months ahead of us. And as such, liquidity on the JSE is near non-existent.
I think that is a bit concerning, and I'm keen to actually delve into some of these small caps. Some of them more popular than others, Anthony, maybe starting off with the one I think is most popular, which is Italtile. Also, they came out with numbers yesterday, and I'd say disappointing. I'm keen to get your thoughts.
Yeah, Italtile is a quality mid-cap company. Its market value is roughly 14 billion rand. It's one of the larger blue-chip mid-caps that I cover. It's been around for nearly 50 years, owned by the Ravazotti family, and its brands of Italtile, CTM, and Top T are very well known to all your listeners. But as we all know, for the last couple of years, the domestic economy, particularly of high interest rates, the cost of living, and other factors, has seen the overall refurbishment and DIY market fall in a heap. And the likes of a cash-built Italtile and the others have had a very weak performance in the last couple of years. And sadly, that is not immune to the large blue chips like Italtile, which reported results out yesterday with earnings actually down by about, looking at my numbers here, profits were down 16%. And even though revenue was only marginally down, I spoke to the CEO, Lance Foxcroft, this morning, first thing, and he sees no recovery in the overall market until at least the latter half of the second half of this year. There's too many unknowns. We have no idea what the finance minister will do tomorrow regarding taxes or potentially VAT. We have no idea who's going to be in charge of this country from April or May regarding the government or any coalitions. And we have no idea what economic policies that said government will potentially enact in terms of economic growth or interest rates. So as it stands right now, the DIY and refurbishment sector, which cash built and Italtile, amongst others, are the largest players, are basically going nowhere, and earnings are actually falling like on like.
What also I think interesting here is that you're actually speaking about consumers and all the things that affect South Africa's consumers and the uncertainty hanging over our heads. And I'm wondering if everything kind of stayed the same and then we saw interest rates go down. Could that be a huge boost for Italtile?
Absolutely. Listen, everybody's proud of their own homes. And at the end of the day, we all want to live in a home which we feel is comfortable to our surroundings. During COVID, when nobody had anything better to do apart from redecorating their house, retiling, putting in new kitchens, etc., we saw a massive boom in the underlying market that Italtile, Cashbuilt, and the others actually service. And as we saw the economy start to weaken and the food price inflation start to increase and interest rates, everything became more expensive. And at the end of the day, are you going to pay your bond, your car loan, your credit card, and put food on the table, or repaint your house? The answer is easy. So you do the most important things first. Everything else gets delayed. And I think we actually need to see some GDP and economic growth, and more importantly, interest rates to decline for this sector to start to rally again. And I think that's quite a few months away, says he, touching some wood. But it could all change tomorrow if the minister puts up taxation, or even worse, VAT. Then I think that the sector could potentially be dead in the water for another 6 to 12 months. Everything hinges on tomorrow.
Another interesting thing I think they brought up yesterday, Anthony, is the issue of Sasol and gas. I think, I've recently had a conversation actually with, gas users, and they're concerned about the sustainability in 2026 and beyond. I'm wondering how Italtile is making sense of this. I kind of think that they do depend on Sasol for their gas.
Yeah. Yeah, this is going to become an extremely important issue to industry as we head towards 2026, when the Sasol pipeline, which has been pumping gas into the reef or the Highveld for many, many years, actually starts to lose pressure and will ultimately not be able to meet the demands of the large industrial users. You know, we as a country are energy dependent. We tend to import much of our needs. And as the gas we produce or import from offshore starts to wane, we either have to rely on other forms of energy like coal, which is not exactly ESG friendly. We can't rely on electricity for obvious reasons. And we have to look for other avenues. And it takes a great deal of time to build imported LNG or LPG terminals. So we could be hitting an energy crunch in a few years, and everybody is scrambling to try and come up with a plan. And so far, there isn't one. So we could be in a very interesting space in a couple of years where very, very large industrial users are running around like headless chickens, trying to find a source of energy unless Eskom pulls its finger out and actually starts fixing its power stations.
Sounds like a very scary thing, and not what we've been promised to date by government, Anthony. All we can do, I guess, is wait on that one. I'm keen to move on now and look at Transpaco. They've been aggressively looking for acquisitions, but I think it's interesting just to take stock of the business as it's been trading.
Yeah, it's a small company. Its market value, as I stand right now, is 976 million rand. So SETI, looking at its data points, trading at 29.25 rand, which is in the middle of its trading range of a year. Its low is about 25 rand, its high is 39 rand. They came out with results yesterday, interim results, which were fairly weak, as one would expect for the consumer environment in this country. Revenue down just under 5%, operating profit down 12%, and headline earnings per share only down 6% because there was a share buyback in September last year, which basically assisted the underlying headline earnings per share. Now, this is a good little company, very niche. Jenny has operated quite well. But given I cover the entire packaging sector, which includes Novus, Caxton, CTP, Bowler Metcalfe, amongst others, the entire environment has been extremely difficult, with an inability to actually recover higher input costs and to get the consumer and the clients to actually pay up for the higher costs that industry is facing regarding paper and pulp, plastics, polymers, energy, etc., etc. And Transpaco, as good as it is in exactly the same position. So sadly, it came up with slightly weaker results yesterday, but as a slightly illiquid small cap, the share price didn't really react. So it's stuck in the same place as many other companies where there's a bit of a margin contraction because they simply do not have the flexibility or the muscle to push through higher pricing because the consumer and the clients simply will not accept it.
I must also ask you about, returning shareholder value in this environment. We've seen Transpaco speak of acquisitions. Then they said they can't find great ones, and so they're just going to buy back their own shares. And I'm wondering how the investors have, reacted to the efforts to still keep, returning value.
This is a great question. Many companies on the JSE, and I've been covering the JSE now for the best part of nearly 40 years. There is grey in this blonde hair hidden away somewhere. And I've seen ratings at historically low levels. But at the end of the day, there are many private companies out there which perhaps the family or the descendants may want to sell. Buying valuations they want remain unrealistic. I can buy companies listed on the JSE on P's of 3s, 4s, 5 and 6. But private companies still think they're sitting in the heydays where they can get price earnings ratios in the high single digits or early teens, which is never going to happen, which is why the listings on the JSE haven't happened. But private equity are very happy to pay those multiples because they have a much longer term time horizon. So many companies, sadly, cannot place paper to fund their acquisitions because, one, the market doesn't want the paper because they're quite small. Two, family companies won't sell, and the only option they have is to do share buybacks, which the market does like, which then exacerbates the underlying liquidity of a company. So it's one of these terrible Mobius loops where deals should be done, but they can't because the underlying ratings of the said small cap companies are too low, because institutions and the wider market, quite frankly, don't give a damn about these small companies performing quite well.
That is a rather sobering reality we see there with our small caps. I mean, another interesting thing about Transpaco is just how healthy the balance sheet looks. I think that's an important part of the company, which makes it, able to take advantage of anything that should come about, but also weathering the storm. Good balance sheets are good for the kind of financial realities we see and where we are in the economic cycle.
Absolutely. I think many companies that I cover, Italtile is the example this morning. So its net cash year on year rise 76% to 1.5 billion rand. So as many of the smaller players either go bust or struggle in this dire economy, the larger companies with secure balance sheets will ride out the economic maelstrom we currently have and come back stronger, picking up market share from many of the independents, but will likely go bust or be liquidated in the next 12 to 18 months. So companies with solid balance sheets, the place to be for the next 6 to 12 months. And there are many on the JSE completely being ignored.
I also want to move on now to a Copper 360 and that capital raise. Anthony, I think, of course, the world is bullish on copper right now.
Yeah, copper is a fantastic metal. For many years it was mainly used in the housing and construction industry for old-fashioned piping. But with the rise of renewable energy, wind power, and of course electric vehicles, copper is now seen as the new metal for the new age and the energy demands of the world. And it is commonly known there isn't enough copper being mined currently to meet potential or future demand. And the ability to actually source copper is going to become a huge problem going forward for the next 10 to 15 years. Copper 360 listed last year. The share price initially went at 20 Rand on a lot of speculation and flurry, and then fell all the way back recently to 2 Rand 86. And I commented on my Twitter page last Friday. I couldn't understand why the share price had fallen 22% in one day. And then, of course, yesterday we found out they did a 100 million Rand placing, an issue for shares for cash, where a company took a 5.84% stake in the company regarding its expansion into Zambia. Now that is going to be a good move longer term. Copper is going to be in demand. But companies often do issues for shares for cash when they need to raise money quickly. The market doesn't often like them because it leads to earnings dilution. And unless you're on the right side of who gets that stock, you generally get left out in the lurch. So I think many institutions yesterday and investors were a little bit aggrieved that the stock was placed by the company into other hands at a price, and they took their fury out on the stock, which fell sharply, but it did rebound overnight to get back to nearly the levels of the placement price. But longer term, the expansion of Copper 360 into Zambia, which is a known copper producing belt, will be a good long-term scenario. But the share price, I must say, has been extremely volatile. 2 Rand 86 to 20 Rand in less than 12 months is enough to give anybody a heart attack.
I must also ask you, Anthony, what we are seeing with companies that are keen to raise capital at this point is really avoiding debt at all costs and really going into the equity route.
Well, again, if you can get away with placing equity, then it's always the most opportune and elegant mechanism to do it, depending on, of course, on your rating. But in many cases, I'm unaware of many companies in my universe that have actually used paper to fund transactions because simply either the underlying participant selling the company doesn't want the paper, the institutions are often reluctant to take the paper on board, and in many cases they want such a large discount to take the paper it becomes unviable. But to give one example, sometimes it does happen when Transaction Capital unbundled or will unbundled We Buy Cars. They're doing quite a substantial capital raise, and institutions were clamoring to get that paper because they can get a meaningful stake in a company before listing at a decent price. So it all depends on the nature of a placement, the size of a company, and the underlying industry that is looking to raise the money. In We Buy Cars' case, they were lucky. In Copper 360's place, they had to place the paper with the underlying vendor who was selling the Zambian interest with an ability to buy back that paper in due course. So as they say, it's horses for courses.
With that said, Anthony, I'm wondering if it's worth it to rate these. I think they're all very different counters with their different dynamics. For a retail investor who is possibly considering any of them, is it worth it?
I'll rate them very easily. Given we have a budget coming up tomorrow and an election, I wouldn't touch any of them. I would put your money in cash, sit back and wait. It's as easy as that.
That, I think, is very solid advice. So with that said, our educational segment today, we're talking about X and cum dividend.
Yeah, that's, again, an interesting point, and I'll use a direct example. I covered a paper packaging and education company called Novus Holdings. Market value 1.5 billion rand. The company, about 2.5 weeks ago, announced a 50-cent special dividend. The share price was trading at R4.40, and on the back of that special dividend news, the share price quickly ran to over R5. So the investors were hoping to what they call dividend strip, where you buy the shares ahead of the ex-dividend date, which is the date you have to be on the share register to actually gain the dividend from the company. What normally then happens ex-dividend is the share price falls back usually by the amount of the dividend that is paid, which in this case was 50 cents. So the ex-dividend date for Novus was yesterday, so you would have got your 50 cents. But the share price actually ran higher. It went to R5.09 to close in the auction. So you would have made money on the upside, collected 50 cents, and the share price would have gone up. But again, today, the share price has come all the way back to R4.33. So if you catch it right, you can actually make money in terms of capital gain on buying the share on a nice dividend, and you get the dividend as well. But that's in a very rare and exceptional circumstance. Normally, ex a dividend, the share price falls by the value of a dividend.
Well, Anthony, always a pleasure hearing from you and also learning from you. It's been an absolute pleasure.
Great. Take care.
You too. That was Anthony Clark from SmallTalkDaily Research.